Welcome back to the Deep Dive. It is Tuesday, February 17th, 2026. And if you've been glued to the terminal today or, even just casually glancing at the ticker tape, you might be feeling a distinctive sense of vertigo.
Vertigo is absolutely the right word for it. It's one of those days where the headline numbers, the big green plus signs next to the indices, are actively hiding the real story.
Right.
If you just look at the summary, everything seems fine, but then you peel back that top layer, and it is a mess of contradictions down there.
That is exactly what we're here to do. We are going to peel back the layers. Because on paper, we have a green day. The Dow, the S&P, the NASDAQ, they all finished higher.
They did, but barely.
But then you look at the engines of this market, the Magnificent Seven, and the engine block is basically cracked. Most of them were down.
It's a classic decoupling event. Usually in the last, few years, the algorithm has been pretty simple. Mag 7 goes up, the whole market goes up. Mag 7 goes down, market goes down.
Right, it's been a simple correlation.
But today, that correlation broke. And when correlations break, that's when things get really interesting.
So here is the mission for today's deep dive. We aren't just reading the closing bells. We're going to try and figure out why the market behaves this way when these massive conflicting forces collide.
And we had a few of them today.
We did. We had a collision of, I think, three huge narratives. First, you've got the AI hardware story getting a second wind. Then there's a geopolitical crisis involving actual aircraft carriers that the market is, seemingly ignoring.
Or pricing in a completely different way than you'd expect.
Exactly. And then we have a historic correction in one of the world's biggest companies, Amazon, finally snapping back.
Plus, you can't forget those really strange signals from what you might call the real economy stocks. I mean, Walmart and Intuit.
Right. So here's the agenda. We're going to start with that green board, the scoreboard for the day, and really analyze the quality or maybe the lack of quality of this rally. Then we'll do a deep dive into the two towers that held the market up, Apple and Amazon. We need to talk about why Apple is supposedly putting cameras in AirPods, which sounds like a spy movie gadget to me.
It does sound a little wild.
And then why Amazon, losing $450 billion in value, is somehow considered just a correction and not a full-blown crash.
Then we have to look at the losers, the real economy warning signs. Walmart and Intuit, like I said, took some heavy, heavy hits today. And honestly, the Intuit story is terrifying if you work in any kind of professional services.
And then, my favorite part, the paradox. We have U.S. aircraft carriers deployed to the Middle East, tensions are high, and yet gold and silver are crashing. That defies every textbook I've ever read. You're going to have to explain that one to me.
It's a lesson in how algorithms process news versus how humans process fear. We'll definitely get into it.
Okay, good. And finally, we'll wrap up with the big movers, a massive shipping buyout, and a really weird disconnect in the crypto markets.
Sounds like a full hour.
Let's dive in. So let's start with the macro view. Give me the scoreboard for Tuesday, Feb 17, what actually happened.
All right, let's look at the closes. As we said, it was a green day, but it was thin, really thin. The NASDAQ composite finished up 31.71 points. That's a gain of 0.14%, closing at 22,578.38.
22,578. I mean, I can remember when we were popping champagne for NASDAQ 15,000 not that long ago. The scale of these numbers in 2026 is still something I'm adjusting to.
Well, it's a mix of inflation and genuine innovation, right? They both push those nominal numbers up. The S&P 500 added just over 7.05 ticks, to be exact, closing at 6,843.22. That's a tiny 0.1% gain.
Oh, 0.1%.
And the Dow Jones Industrial Average tacked on about 32 points, or 0.07%, to finish at 49,533.2 more times.
We are agonizingly close to Dow 50,000. Feels like the market wants to get there. It really wants to punch through, but it just doesn't have the momentum. It keeps getting winded at the finish line.
It's a huge psychological resistance point. I mean, 50,000 is a massive, massive round number. But here's the real vibe check on today's close. These gains, they're 0.14, 0.1, 0.07. They're basically statistical noise.
So it wasn't a rally?
No, this wasn't a rally. This was a standoff. It was a tug of war.
A standoff between who? What were the two sides?
It was between very specific big cap idiosyncratic stories, basically Apple and Amazon, and then a really broad weakness in just about every other part of the market. It wasn't a broad rally where, the tide lifted all boats.
It sounds more like two boats with working engines were just towing the rest of the fleet.
That's a perfect analogy. That's exactly what it was. And that brings us to the fleet itself. Let's talk about the Magnificent Seven, because they usually move as a pack. If Apple is up, you'd expect Microsoft and Google to be tagging along. But today, the pack just splintered, completely fractured. If you look at the other members of that club, they were dead weight today. Tesla, for instance, led the decliners, dropping 1.6%. Alphabet, Google's parent, shed 1.2%. Microsoft gave back 1.1%. And Meta was effectively flat, just inching down 0.08%.
Okay, stop there for a second. Microsoft and Google are usually the safe havens of big tech. They're the blue chips. If they're down over 1% on a day when the Nasdaq is actually up, that implies a massive rotation is happening under the surface.
It absolutely does. It tells you that capital was flowing out of those software and search giants and into something else, something very specific.
Right.
For the indices to finish green without Microsoft or Google participating is, well, it's statistically rare.
Right, because of the weighting.
Exactly. Microsoft has such a massive weighting in both the S&P and the Nasdaq that for it to drop 1.1%, it creates this huge hole that other stocks have to fill.
And what's filling that hole today were Apple and Amazon. Let's start with Apple. Ticker AAPL, up 3.2% today. That's a huge move for a company with a multi-trillion-dollar market cap. What lit the fuse?
It wasn't earnings, and it wasn't a new iPhone release. It was rumor, just pure, uncut hardware speculation. A Bloomberg News report started circulating today claiming that Apple is accelerating its work on completely new product categories. And the market, which has been, let's be honest, somewhat bored with the whole rectangle in your pocket paradigm, suddenly woke up.
So what are these new product categories?
The report specifically mentioned two things: AI-enabled glasses and camera AirPods.
Camera AirPods. Okay. I need you to explain this to me because my immediate mental image is ridiculous. I'm picturing a tiny camera lens sticking out of my ear. Why would anyone possibly want that?
It does sound absurd at first glance, I get it. But you have to think about this in the context of multimodal AI. Right now, if you use an AI assistant, you're mostly typing to it or talking to it.
Right, text or voice.
But for AI to be truly useful in the real world, to be a real co-pilot for your life, it needs to see what you see. It needs vision.
So it's about giving the AI context.
Exactly, total context. If you're wearing, say, glasses with cameras, or even just earbuds with low-resolution cameras pointing outward, the AI can see that you're looking at a menu in French.
Yeah.
And it can whisper the translation into your ear instantly.
Okay, that's actually useful.
Or it could see that you're looking at a broken sink part in your hand and tell you, that's a 34-inch P-trap washer. You can buy it at Home Depot for $2.
So the camera AirPod isn't for taking selfies. It's about giving the AI a pair of eyes so it can whisper answers to you about the real world.
Correct. It's all about what they call ambient computing. And the market loves this because it represents the super cycle that everyone has been waiting for. We've been waiting for the post-smartphone era for years.
Right.
And if Apple can successfully launch a wearable that either replaces or at least heavily augments the phone, that opens up a completely fresh revenue stream that could last for a decade.
But I mean, didn't we try this already? We had Google Glass, 10, 12 years ago? It was a disaster. We have the Vision Pro, which, let's be honest, it's a technical marvel, but it's a commercial niche product at best. Why does the market believe it's going to work this time?
I think it's because of the AI backend. That's the missing piece. Google Glass failed because it was basically just a notification screen on your face. It didn't do that much. The Vision Pro is too heavy, too expensive, too isolating for everyday use.
Yeah, you can't walk down the street with it.
Exactly.
Yeah.
But a lightweight pair of glasses, or just your normal AirPods that you already wear, powered by an AI that actually understands the visual world, that is a completely different value proposition. The market is betting that the AI technology has finally caught up to the hardware ambition.
So investors are buying the dream of the hardware renaissance driven by AI.
They are. And that 3.2% move in Apple today is purely a fear of missing out trade. It's FOMO on the next big platform. And it dragged the Dow and the Nasdaq higher almost single-handedly.
All right, so that's the Apple Tower holding up one side of the market. Now let's look at the other pillar of today's rally, Amazon. Ticker AMZN, up 1.19%. Now, compared to Apple's 3%, a 1% gain sounds, pretty modest. You're telling me this is actually the more dramatic story.
Oh, by far. That 1.19% number is misleadingly small. You have to understand where Amazon was yesterday. You have to look at the context.
Okay, set the scene for us.
Amazon has been in an absolute freefall. Before today, Amazon had logged a 9-session-long decline. That means for 9 straight trading days, the stock closed lower than it did the day before.
9 days in a row. How rare is that for a company like Amazon?
It hasn't happened since 2006.
2006. It's 20 years ago. That's before the Kindle. That's before AWS was even really a thing.
Exactly. We're talking about a completely different era of the internet. For a company as dominant as Amazon to have a losing streak that long in 2026, it suggests a massive crisis of confidence among investors.
So what was the damage from that streak?
Over those 9 days, Amazon shed approximately 18% of its total market capitalization.
18%.
And in dollar terms, that is roughly $450 billion.
Okay, I want to pause on that number. $450 billion.
Yeah.
It's unfathomable. That is larger than the entire GDP of nations like Austria or Egypt. That's more than the entire market value of companies like Disney or Coca-Cola. And it just vanished in 9 days.
Poof. Gone. And this brings up a really provocative point about the modern market, doesn't it? We talk about these trillion-dollar valuations as if they're solid concrete. But if $450 billion can just evaporate in less than 2 weeks because of a bad earnings report or a sector rotation, how real was that value in the first place?
It feels like monopoly money when you talk about numbers that big. But for the pension funds and the retail investors who are holding Amazon in their 401ks, that loss is very, very real. So why did it finally bounce today? Did they announce some great news?
No news at all. It was just exhaustion.
Selling exhaustion.
Yes. When a stock drops 18% in a straight line like that, eventually you just run out of sellers. Everyone who wanted to panic sell has already panic sold. The algorithms look at technical indicators like the Relative Strength Index or RSI, and they see it's deeply oversold, so the buyers finally step back in.
So not because the business fundamentally changed overnight.
Not at all. It was just because the price got cheap enough to justify the risk. It was a technical bounce, not a fundamental one.
So is this a dead cat bounce?
Yeah.
Or do you see it as more of a relief rally?
I'd call it a relief rally for now. The bleeding stopped. And because Amazon is so massive, even a 1% bounce adds tens of billions of dollars back to the index's market cap, which effectively neutralized the big losses from Microsoft and Google.
It really highlights how fragile the market leadership is right now. You've got Apple rallying on rumors of future products and Amazon rallying just because it stopped crashing. That doesn't exactly scream healthy bull market to me.
No, it's definitely not a high conviction market. It's a very reactive one.
Speaking of reactive, let's leave big tech for a minute and look at the real economy. Because while the tech giants were playing this tug of war, the companies that actually sell things to people and, do their taxes were getting absolutely hammered.
Yeah, the red on the board today was very concentrated in consumer and enterprise staples. Walmart and Intuit were the ugly ducklings of the day, for sure.
Let's start with Walmart, ticker WMT. It was down 3.8%. But here's the weird part. Didn't they hit a record high today?
They did. Earlier in the session, Walmart actually tapped an intraday all-time high. And then it was like a trap door opened underneath the stock.
So walk me through the psychology of that. Why would everyone rush to buy it in the morning, pushing it up to a record, and then just dump it by the afternoon?
It's a phenomenon we call exhaustion at the top. When a stock hits a widely watched milestone, like an all-time high, it can trigger a huge wave of automated sell orders. People take profit targets in their brokerage accounts. They tell their system, if Walmart hits X dollars, sell it.
So it's programmed selling more than human panic.
It starts as programmed selling, yes, but it also reflects a sell the news mentality. Investors might feel that Walmart is just priced for perfection at that point. The consumer economy is still a bit shaky. Inflation is a lingering ghost. If you've made a 20% profit on Walmart stock and it hits a record high, are you going to hold on for another 5%? Or are you going to cash out and, buy a boat?
And today, the market chose the boat.
Today, the market chose the boat.
Fair enough. Profit-taking I can understand. But Intuit feels darker. Ticker INTU, down 5.1% today.
This is the TurboTax parent company.
Right. And we are in the middle of February. This is peak tax season. This should be their victory lap. Why are they crashing when their product is most in demand?
Because the market is already looking past this tax season. Intuit is in a brutal downtrend. The stock has lost, get this, 44.1% of its value since its intraday peak on December 29th.
44%. Nearly half its value gone in just 6 weeks.
It's a bloodbath. And today's drop was specifically triggered by 2 different analysts downgrading the stock and cutting their price targets. But the reason for those downgrades is the real story here. It's all about the AI displacement thesis.
Okay, break that down for me.
For decades, Intuit has made billions in dollars by being the middleman between you and the IRS. They took a complex tax code and simplified it with software. But now we have these advanced AI agents, and the thesis is, why do I need TurboTax anymore?
Right.
Why can't I just upload my W-2s and my bank statements to a secure government-run AI or even just a generic AI assistant and have it file my taxes for me for free in about 10 seconds?
So the fear is that AI makes the entire category of tax preparation software completely obsolete.
Precisely. If AI commoditizes that kind of knowledge work, then paying $100 to use software to do your taxes starts to feel archaic. The market isn't just worried about a bad quarter for Intuit, it's pricing in the potential extinction of their primary business model over the next 5 to 10 years.
That is harsh.
Yeah.
But I guess if you're an investor, you're not paying for what Intuit earns today. You're paying for what they're going to earn in 2030. And if 2030 looks like free government AI, then yeah, Intuit is worth a lot less.
Exactly. It's a structural threat, not a cyclical one. And that's why the stock is down 44%, not just 5.
And it wasn't just Intuit, was it? We saw a lot of other software and even hardware names struggling.
It was a bad day for legacy tech across the board. In enterprise software, you had Salesforce CRM down 2.9%, Oracle ORCL dropped 3.9%. These are the titans of the database and CRM world.
So a similar fear there.
A very similar fear. The market seems to be rotating out of these big system of record companies. The question is, will AI allow companies to build their own custom CRMs on the fly? Do we need these massive, expensive legacy software suites anymore?
We also saw some hardware and retail names get hit.
Yeah, SanDisk, the memory company, was off 5.7%. CoreWeave, which is in the data center space, was down 5.3%. And in retail, it wasn't just Walmart. Home Depot HD was down 2.1% as well, signaling some weakness in consumer spending on big-ticket items.
It's fascinating. On the one hand, you have Apple soaring because AI needs new hardware to live in. On the other hand, you have Intuit and Salesforce sinking because AI might replace their software. Same technology, but it's picking winners and losers so violently.
That is the story of 2026, I think. AI is no longer a rising tide that lifts all boats. It's a tsunami. It's a tsunami that destroys some coastal cities while providing immense power to others.
Let's shift gears to this segment I've really been waiting for, the geopolitical paradox.
Ah, yes. This is the one that really confuses the logic investors.
Okay, so here's the setup. You turn on the news today. The headline is, Washington dispatches 2 aircraft carriers to the region. Tensions with Iran are spiking. You see images of fighter jets taking off from a carrier deck.
Right. It's a very high alert, tense scenario.
In every history book, in every investing 101 class I ever took, they teach you, when the war drums are beating, you buy gold. It's the ultimate safe haven asset. It's the flight to safety.
Correct. Uncertainty is supposed to equal gold demand.
So logically, gold should be soaring today. I mean, we're already near $5,000 an ounce. It should be hitting maybe 5,100, 5,200. But what actually happened?
The complete opposite. Gold crashed. It eased 2.9% to close at $40,900.70, and silver got hit even worse. It tanked 5.9% to around $73.36 an ounce.
Okay, make it make sense. We have U.S. aircraft carriers moving into position, and investors are selling their safety blanket. Why?
It comes down to the nuance of information flow in the modern market. The news about the aircraft carriers, that was actually old news.
Old news. It was the headline today.
It was the headline for humans today. But in the age of satellite imagery and 24-hour intelligence leaks, the market's high-frequency trading algorithms knew those carriers were moving days ago. That fear was already priced into the market. That's likely why gold hit its record high back on January 29th. The market had already bought the rumor of war.
So what changed today to make them sell?
A single headline crossed the wires from Tehran. A very small one. Officials there reported apparent progress in diplomatic talks on Tuesday.
Apparent progress. I mean, that sounds incredibly vague and noncommittal.
It is vague, of course it is, but for the algorithms that trade commodities, it was enough. The market operates on probabilities. Yesterday, the algorithmic probability of a kinetic war might have been, say, 60%. Today, with that one headline, maybe it dropped to 40%.
And so the risk premium just deflated instantly.
Instantly. The algorithms saw the word progress associated with talks and immediately dumped their long gold positions to lock in the profits they'd made on the run-up. They are betting that the diplomats will win and that the aircraft carriers are just for show, just posturing.
That feels incredibly risky. I mean, diplomatic talks fail all the time. If tomorrow the talks collapse, gold is going to rip higher again, right?
Oh, absolutely. If a single missile is fired by either side, gold goes to $5,200 in a heartbeat. But for today, for this 24-hour period, the market decided to bet on peace. It's a risk-on move in a very weird way. Selling safety implies you think the danger has passed, at least for now.
It's just amazing how the market tries to quantify these geopolitical feelings. How much is a diplomat's vague word worth? About $100 an ounce of gold, apparently.
It's a cynical calculator, but it's the only one we have.
All right, let's move from the war room to the boardroom. We had some massive M&A news today. Let's talk about the big movers.
The shipping industry is getting smaller again. ZIM Integrated Shipping, the ticker is ZIM, was the absolute star of the show today.
Just skyrocketed.
They did, up 25.5% to close at $27.85. The news is that Hapag-Lloyd AG, the huge German shipping giant, has agreed to acquire them.
Consolidation in the supply chain. That's always a big story. But I want to talk about the math here because this is a great lesson for our listeners on how buyouts actually work in the real world.
Yeah, let's break down the arbitrage.
Okay, so Hapag-Lloyd agreed to buy ZIM for $35 per share.
Correct. A $35 cash offer.
But the stock closed at $27.85. That's a difference of, what, $7.15 per share?
Yeah.
So if I go out and buy ZIM stock right now at $27.85 and the deal goes through as planned, I get handed $35 in cash. That is a guaranteed 25% profit. Why isn't the whole world buying this stock right now? Why isn't it trading at $34.99?
That gap, that $7.15 spread, is what we call the risk premium, or the arbitrage spread. And it tells you exactly how skeptical the market is that this deal will actually close.
What could possibly stop it? The companies agreed.
Regulators. Antitrust laws. We're in 2026, remember? Governments in both the EU and the US are incredibly hostile to mega mergers, especially in critical infrastructure sectors like shipping. Shipping rates drive inflation. If Hapag-Lloyd buys ZIM, they control a massive chunk of the Atlantic trade routes. The market is terrified that the DOJ or the European Commission will step in and block the deal.
So the market is essentially saying, we think there's maybe a 60 or 70% chance this actually happens, but not 100.
Exactly. If the deal closes in, say, 6 months, and you make 25%, that's a 50% annualized return. That's a massive, massive return. The fact that the potential return is so high tells you that the perceived risk is also very high. There's no free lunch on Wall Street. If that deal gets blocked, ZIM stocks probably falls right back to $20.
So that $7 gap is the price of fear.
That's a perfect way to put it. It's the antitrust discount.
We also saw the power of the analyst godfathers today, Lumentum, ticker LITE, up 6.7%.
Yeah, Lumentum. They make optical networking gear things like high-powered lasers for data centers. It's essential stuff for the AI infrastructure build-out.
And what was the catalyst for their jump today?
A single analyst note. An analyst at Mizuho boosted their price target on the stock from $525 all the way up to $645.
It's just wild to me that in a market worth trillions of dollars, one person at Mizuho typing, I think this is worth more, can instantly add hundreds of millions of dollars to a company's market value.
It shows that despite all the AI trading and all the algorithms, the simple expert opinion still carries a lot of weight. Investors are always looking for validation. When a reputable firm like Mizuho comes out and says, this is going to 645, it gives everyone else permission to buy. It becomes a self-fulfilling prophecy.
Permission to buy. I like that phrasing. It's like the whole herd of sheep is just waiting for the sheepdog to bark.
A very, very expensive sheepdog.
Let's wrap things up in the crypto corner, because this was another area where the correlations we normally expect they just broke down today.
It was a very disconnected day for crypto assets. If you just looked at the coins themselves, you'd probably say boring day. Bitcoin was down about 0.8% to around $67,600. Solana was basically flat. Ethereum was up a little. Ripple was up a little, just chopping sideways.
Right. Typical consolidation after a big run. But the crypto stocks, the companies that mine the coins or hold the coins on their balance sheet, they got taken to the woodshed.
They really did. MicroStrategy, MSTR, dropped 3.9%. The miners like Bitmine Immersion and Iron were down between 3 and 4%. Even infrastructure plays like Applied Digital and trading platforms like Robinhood fell.
So why the disconnect? If Bitcoin is flat, why is MicroStrategy, which is basically a leveraged Bitcoin bet, down almost 4%?
It's a leverage unwind. You're right. Stocks like MicroStrategy and the miners are often used by stock market investors as high beta Bitcoin bets. That means they're expected to move more than Bitcoin in both directions. If Bitcoin goes up 1%, MSTR might go up 3%, but it works in reverse too.
So as Bitcoin sneezes, the miners catch a cold.
Exactly. But today, specifically, it looks like equity investors, people trading on the stock market, were in a general risk-off mood. Remember, Intuit crashed, Walmart crashed. The internal market breadth was really bad. And when stock investors get scared, what do they sell first? They sell the riskiest stuff in their portfolio.
And crypto stocks are pretty much at the top of that list.
They're at the absolute top of that list. So the coin holders, the, crypto natives, they were chilling, holding their Bitcoin. But the stock market tourists who own the miners got spooked by the broader market weakness and sold.
So it's a divergence of sentiment between two totally different classes of investors.
Precisely. It shows the ecosystem is still fragmented in that way.
So let's bring it all home. We've covered a lot of ground today, from camera AirPods to diplomatic gold crashes. What's the big takeaway for you? What's the theme of the day?
I think the theme today is the illusion of stability.
Expand on that for me.
Well, if you just glance at the S&P 500, it looks stable. It's up 0.1%, calm. But underneath that calm surface, you have these violent rotations. You have $450 billion vanishing from Amazon and then partially reappearing. You have entire business models like tax software facing an existential crisis from AI. You have geopolitical algorithms playing chicken with aircraft carriers.
It feels like the market is just frantic underneath a very thin veneer of calm.
It is frantic. It's trying to process the future of AI, the future of global conflict, and the future of consumer spending all at the same time, and it's coming up with completely different answers every single hour.
And that leads me to my final provocative thought for everyone to chew on. I just can't stop thinking about that Amazon stat.
The $450 billion loss.
Yes. We treat these market caps like they're real money. Amazon is a $3 trillion company. But if it can lose 18% of that value, more than the GDP of most countries, in just 9 trading days, based mostly on sentiment, and then bounce back just because it fell enough, are we actually investing in value anymore? Or are we all just surfing on a sea of liquidity and volatility?
That is the trillion-dollar question, isn't it? In 2026, value is incredibly fluid. It's not about how many boxes Amazon ships in a quarter. It's about how the market feels about Amazon shipping those boxes. And feelings, as we all know, can change very, very fast.
It's a fragile thing, this concept of valuation. Something to keep in mind the next time you look at your portfolio and feel rich or poor. It might just be the mood of the market that day.
Indeed. Stay grounded in the fundamentals because the prices can be a whirlwind.
Keep digging, keep learning, and don't let the green headlines fool you. We'll see you in the next deep dive.